The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome on back here to the Diagnostic Trading Hour. I'm your host, Darrell Martin, right here on TFNN. Don't forget, you can listen to us anywhere on your phone at TFNN.mobi. Well, let's check out the markets where they're at right now after that big run up yesterday with unlimited QE and the destruction of your dollar. Let's go ahead and check it out. We got the S&P down 2 points. We have the Nasdaq is currently up 7.5. We got the Russell down 2, almost 3 points right now. We got the Dow down to a little 25 points at the moment. Gold is up 65 points. Of course, again, that's from yesterday's settlement price. Pretty much all that movement happened within, about two-thirds of it happened in a second. And about the other third happened over the course of an hour yesterday after gold settled at 130. We got silver also way up again. Most of that move yesterday. 7%, 5% on gold, and that's obviously breaking the mold. So that's way beyond deviations. We're looking at like 4 deviation moves on that. We'll get on over at oil. Oil is down $1.11 right now, down 1%. We got natural gas down 0.7. Corn is looking like it's pretty flat on the day there. We got soybeans is currently down 15 points. Euro dollar is currently, I don't even know if corn, it seems like it's not quoting. There it goes. Okay, yeah, it's only up a tick. It's flat. But euro dollar is down a tick. We got pound dollar down 112 ticks after the news that came out last night was spot on the money right there. Great news trade. We got Aussie dollar down 78 ticks. Euro yen up $1.95. US yen up $1.52. So, the one place you're seeing a true U.S. strength right there, huh? Right there against the yen. Pound yen up $1.31. Dollar CAD up 20 pips on the day. And dollar franc flat on the day. All right, so that gives us a wrap for where the market's at. And some things to talk about. This morning, I was looking at the markets, and we had obviously that massive run up yesterday. And it was followed by the, a little bit of a drawdown. And I was looking at it, I was like, you know what? This is a great gap fill setup. And let me pull it up. We'll go through it step by step so I'll let you see how that worked. But just a really good gap fill setup this morning. And I will also do a quick review on the news trades that happened this morning. We had butterflies that worked out great. We also had a straddle last night you could have done on pound dollar. That was excellent as well. So right over here we got the S&P. And this, looking at it this morning, looking for the gap fill. And gap fill, what is that? Well, where did the market settle at yesterday? 1717.75. Where did the market open today at 9:30? So we can go over here. We'll drag, we'll put a level right here at 9:30. There we go. So we got the market opening up and basically giving us about a 5-point gap. And a lot of people, they don't know what gap fills are at first. You find out about them pretty quick. But basically, it's where the market opens higher than where it officially settled, closed out yesterday. And this is for the indices. Okay, this isn't really something you do on FX and commodities because they're trading all night long. And even though the index futures are trading all night long, remember, they're an index of something else. Oil is actually oil, okay? Whereas a cash index like the S&P is based on 500 stocks that were not trading last night. So whenever the market closed down last night, it kept, going on up. And therefore that creates the gap because now between, here and here, there's all these orders that have yet to be filled on the S&P. On the stock orders, limit orders that people had out there. And so you could have hopped in right over here and went short as the market opened up. And then it came on down and perfectly filled that gap. And, you can see you got the S&P short trade there, but we actually did a Nadex gap fill trade. And so let's pull that up and look at it. and go through that one step by step, let you see how that worked, okay? We'll go over here, pull up Nadex account. I'll order up the order history from right there. There we go. Okay, so what we did is I went in and I shorted the 1716, which was, basically the closest strike I could get to where the strike was, and get a 1-to-1, or close to 1-to-1 risk-reward ratio. And I sold it for $78, making my risk $22 on the trade. Okay, so if I sell, I'm saying it's going to expire at or below 1716 by 415. Now, I don't care if it expires at or below. It doesn't need to expire at or below. I'm going to close it before it gets there. But the point is, I have until 415 to be right on the trade, and my risk is only $22 a contract. I did 10 contracts. So if you go in and you short that trade, a binary's maximum value is $100. And so if you sell at 78, the worst loss it could obtain is going up to 100, because that's the highest value of a single binary contract. So that'd be 100. So 100 minus 78 equals 22. And maybe I can zoom in a little bit more, make that easier for you to see if you're watching over on Tiger TV. And put that right up there. So I've actually put in an order to sell for 74. As a limit order got filled at a better price, got filled $4 higher at 78. And market proceeded on down. And as it went down, I put in a take profit right around 57. So as it got close to 1716, it would take my profit, also be the gap fill. Usually, now I will tell you, usually when I do gap fills, I close them when the gap fills, because very, very often they'll hit it and bounce off of it. Today I had two reasons to stay in. One is we just had an insane run up yesterday with the FOMC, so I expected a retracement, a pullback. Two is the fact that we actually have a seasonal down day today on the S&P. Today's a seasonally down day, and remember, diagnostic trading is about looking at the way that seasonal traders, fundamental traders, technical traders, and statistical traders look at the market, and then taking advantage of that. And so I put this trade on. We went short at $78, and I put a contract. Then I put an order in at 10.22 for it to fill at 57. And a couple hours later, right there, was filled at $57 as the market proceeded and moved on down over here. So again, just a very, very simple, very easy trade to do. The thing, again, I love about it is, unlike trying to do a gap fill trade on just a future contract itself, I don't have to have a stop loss. I have all day to be right. My risk is capped. And like I said, I have a good, 1-to-1, approximate risk-reward trade. And so if I got filled at 78 and I bought back at 57, I made $21. I was risking 22, pretty close to 1-to-1. And then I did 10 contracts, so net 210. And then take out your exchange fees and, net $192 on the trade. So it's one to look at. It's a really cool trade. Now, another thing to make you aware of on gap trades is be cautious on taking them on up gaps. Right now, with QE the way it is, up gaps have not been the best record for filling. And so I needed a couple other things. And that main thing being, I had two things, like I said, seasonally down day, one, and the second thing being the fact that, we had that massive run, and so I expected a retracement back. So that's why I was willing to hop in on a gap up. Gap downs have done great during QE. So hopefully that's a couple tips for you. You can use that. I have another trade on here that I did as well. You can see this short contract on. I was doing a little lesson for somebody this morning. And I went in and I actually bought 5 Nadex spreads as a hedge. Okay? And basically that cost me basically a point on the S&P. And I bought them up here at 1721.2. So right here I had a spread. And it was a 1720 spread. It went up to, I want to say, it was 1720 to 1730. So right over here, 1720 up to 1730, and it expired at noon. And I actually bought 5 of them. Why did I buy 5 of these spreads? Well, the reason is because every spread on Nadex has a tick value of $1. And all of them tick in an increment of 1. For the S&P, that increment is 0.1. So there's 10, pardon me, there's 10 dimes in $1. And if there's 10 dimes in $1, then a 1 point move on a S&P 500 spread there is going to be $10. a 1 point move on the S&P futures is going to be what? It's going to be $50. So if it's $50 on S&P future and it's 10 on S&P spread and I want to hedge, then I'll buy 5 spreads. That way the spread will make $50 on the way up for every $50 that the future is losing. And since I bought it right here at 1721.2, I had 2 points risk on the trade, so I had $100 risk on the trade. Because my risk is between 1719 and 21, so where I originally bought the spread. Why is that my risk? Well, if I go over here and I sort of plot a little line for you to see this, basically this is where, because the future is going to be losing money, the spread is really going to be making money after this point. This is where it's going to start making $50 a point, okay? And it'll make money all the way up to 1730. At that point, I would need to hop out of the trade. Okay, so if it did go that far against me, I need to get out. The cool thing is, it could go up against me, say, 2 points, 3 points, 4 points, whatever, and I would only be down, even if it was against me 4, 5, 6, 7 points, I'd still only be down, $100 on the trade, 2 points on the trade. And so it lets me get a 10-point stop loss for a cost of $2 or 2 points. So I'm getting $500 risk stop loss, but I only have to actually risk $100. And it's one of my favorite ways to trade futures. Think of it as day trading, options for day traders, or married calls for day traders, married puts for day traders. That's basically what it is. And what's even better is since it's on the day of expiration, this thing's expiring like at noon, you're getting a delta of 1. So you're getting massive. It's not like if I go in and buy like a weekly, call or put, then I have to deal with the theta catching up, having to pay all that, and then I have all the gamma slowing down my delta. And so if it does go 5 points against me, I only get, say, 3 points of coverage, that type of thing. So we're actually getting like full delta coverage after that point right there at 1721. And so that's one of the reasons I like it, because I get great protection. And I can trade outright futures. I don't have the limits of spreads. I don't have to worry about that. I can even scalp on this. So I could go in, and if the thing would have oscillated, I could have went in and sold again and bought, sold again and bought, sold again and bought. So you could actually, if you're a scalp trader, you could use this as a way to hedge your scalps. And eventually you just start doing scalps without, risk on the total trade combined, simply because as the trade keeps going back in to where you bought the spread, you could sell again and you'd have full protection as long as you waited until it got back to where you originally sold the spread. So again, a very, very cool way to trade. And as the market goes down, why would I choose a 12 o'clock? Because, they have 4:15s. I could take this thing all the way out here. Why would I close it that soon? Or why would I choose a 12 o'clock? So I'm going to talk about why I choose a 12 o'clock expiring spread when we get back from this break. Stay right there.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, welcome back here to the Diagnostic Trading Hour. And right now, just checking out where everything is and what all is going on. But we're talking about doing the ultimate hedge strategy here, going in and hedging your futures or Forex trades. And I last left off talking about we had a $100 risk on the trade, but we had a $500 stop loss, which is pretty sweet. So the market could go against us 3, 4, 5, 6, 7, 8 points. We're still going to be down $100 on the trade. And again, this is trading a future contract. So we go short on the S&P, and we only need to make a couple points in order to cover, that risk we had, that max risk we had on the trade there. And we bought it at 1721.2, so we actually only had basically a point of risk we need to make back. We need to make back $50. We made that back as soon as it hit 1718. So at that point, we're break even, no risk on the trade. We then move our stop down to, say 1718 right here. And once we break through this gap, and then we're in the trade, we're ready to go. We get to write it down as far as we want to. We don't have the limitation of worrying about a spread expiring. But we got the benefit of a spread using it as our stop loss. So if you haven't tried this yet, you definitely want to check it out. If you trade futures or Forex, and that's just your main thing. You're okay, I trade futures and Forex. You know what? Would you like to have 10-point stop losses with only the risk of 2 points on a trade? I mean, that sort of answer I would assume would be yes. So if you'd like something like that, then now, if you're a scalper, again, you can scalp with this, like I talked about earlier too. There's multiple ways to do this. But if we only had $50 risk after it went down a point, you could close it. You could literally reset and do this thing over and over. But if that's something you'd like, then that's another huge benefit in Nadex. A lot of people don't think about. They hear about the premium collection. They hear about the binaries. They're like, binaries not. They're not my thing. Okay, I love them, but I totally get it. Everybody has their own way they like to trade. But, everybody wants to reduce their risk. And everybody wants more time to be right just in case the market does go against you. without having to add on the risk. So just as an example, say over here you did the same trade, like right at this point. Let's just say we got in earlier, okay? To show you an example, sort of how it works for you. And you went in, and let's say you got short right there. So the same price, okay? So we'll sort of keep everything the same. But you got short right here. Well, look at this. The market went higher. It went up to 1723. We were hedged, actually. And I don't even have the box. That should be a little smaller. We were hedged starting at 1721.2. So you would have had to take an additional $100 of risk on your trade to stay in this trade, which would have been profitable, but you would have got stopped out, taken a loss, had to decide if you wanted to get in again, and do it all over again. Whereas if you would have hedged the trade, you would have been, you would have been down those, points right there, that extra, couple points right there on your future contract, but you'd also be up those points, those extra couple points on your spread trade. So your net difference, you'd still only be down $100 on the trade. And then it comes on down, you trail your stops, and you're able to manage your trade just like you normally do. You're just putting a hedge on so you don't get kicked out like in the first, hour. So if it doesn't move your way in an hour, it's probably not your trade anyway. Move on. But wouldn't it be nice to have an hour and not have to increase your risk when doing so? So it's a way to basically, in essence, buy time for you on your trades and allow a trade to move against you without having to worry about getting stopped out. And you can use the scanner when you do this. So the spread scanner can be very, very helpful when you're trying to do this strategy. And you just log into it. I'll pull it up over here for you. You go over to the spread scanner. And literally the way I did the trade this morning, I pulled it up. I had my DOM up. And went to the spread scanner. I went and I chose the S&P. Okay. And then I cleared all my filters out and said, well, I'm going to sell the S&P. So to hedge that, I need to buy the spread. And some people go, well, if you're going long the spread and short the S&P, how do you make any money? Remember, the spread doesn't lose any additional money under the floor. So it stops losing at 1720. It's not going to lose anything else. The most it's going to lose is that 1.2 points right there. Okay, so $12, $60 basically on the trade is the most that spread can lose. Once it's lost it, it's still there. It's still open. It's still active. It's just it can't lose any more money. So it's still hedging you, but your S&P contract can keep making money. The spread stops losing money, and that's why you're able to be profitable. Just like buying a call or a put, but a lot better. And then I'll go over here and I'll say, well, if I'm going to sell the spread or sell the future, I got to buy the spread, and then I want at least a 1-to-1. I want a decent risk-reward ratio on the trade, and that's really all you're going to need. You're going to scroll on down, and then we'll talk about how to select the spread when we get back from this break. So stay right there.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. With the stock market flirting with all-time highs and volatility back, now is the perfect time for a 2-week free trial to Market Insights. On Monday, June 24th, Tom O'Brien closed out all 5 open positions in his daily newsletter, Market Insights, with all trades being profitable and ranging from a 2.23% gain all the way to more than an 11% gain in just one position for an incredible 32.7% profit combined between the 5 trades. Let Tom O'Brien's years of market experience work for you. If you'd like to see for yourself what kind of trading newsletter Tom O'Brien delivers to his clients each morning, then now is a perfect time to sign up for a 2-week free trial to his daily newsletter, Market Insights. In a volatile market like we currently have, the potential for fast market moves like we've seen recently is a trader's dream. So don't wait any longer. Sign up for your 2-week free trial to Market Insights today at the front page of TFNN.com. Andy Hecht, the host of the Commodities Hour, recently launched his newsletter service, the Technomental Commodity Report, and only 6 weeks in, Andy has already recorded a triple-digit winner. Andy advised his subscribers to purchase a long-term call option at 46 cents on July 11th, and then sent out a special update Friday, August 16th, advising his subscribers to close that position at $1.40. That's a 204% profit in just 5 weeks. The Technomental Commodity Report by Andy Hecht is released each Thursday morning, and right now you can get a month-long free trial to this subscription while locking in the low introductory rate of only $39 a month. Andy Hecht has been a commodities trader for over 3 decades. Let his experience work for you. Sign up for your month-long free trial to the Technomental Commodity Report today at TFNN.com. Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks, welcome on back here to the Diagnostic Trading Hour. And we're going into the ultimate hedge strategy, where what we're doing is we're trading futures or forex, on CME or spot forex or whatever, but you're just using the Nadex spreads to hedge the position, the box spreads over there. And so now I'm talking about how do you select that best spread. So let's say we're looking at a trade right now. You think the market's going to go down? You think it's going to go short? And the market's sitting right about 17.15 at the moment. And get rid of that. There, got this little marker on here. So, it's sitting right up there, and you can do... Yeah, get rid of it. You can go in, and you can hedge it. So how do you know what the risk is on the hedge? How do you pick that out? And how much time do you want? Well, right here, we go in, we can buy this spread. Now, it only has 24 minutes till expiration, but again, this is just a quick, short, cheap hedge to give you some room, just in case the thing pops up for a few points and then comes back. That one right there, you can buy it at 1715.9. So you'd only have a 0.9 risk, which is less than $50 on the trade if you went in and bought that spread right now and sold the S&P. And you'd have a hedge up to 1725 for the next half hour. Okay? What would that cost you? It would cost you about $50. Okay? Meaning that the S&P would need to drop a point for you to be break even. Everything below that, pure profit. Okay? Now, what about right over here if we look at, we got the, let's check it out. We got, 83 minutes, and this actually gives us an hour and a half, gives us till 3 o'clock, and buy it at 1716.5. So this one would give us a 1.5 of risk from where we're at right now, for an extra $25. So, that's not bad at all. That's $25. You get a 1.5 of risk added on there, but you also get a hedge all the way till 3 o'clock. So to do this trade, what you do is you literally sell the S&P and buy 5 of these spreads. So see, this is 1 ES equals 5 Nadex US 500 spreads. So you buy 5 of the spreads, sell 1 S&P future contract, and your risk on the trade would be 1.5 points. So that'd be like having a 3-point, or not, that'd be like having a 1.5 point stop loss, but getting a 10-point stop loss. So you're only risking like $75, but it can go against you $500, and you'll still be profitable on the trade. Or not profitable, but you'll only be down $75. If it goes against you $500, you'll only be down $75 net between the future contract and the spread contract's profit. And then if it goes down, you take profit, great. That's awesome. Show your stops. You don't care if the thing expires. Like my 12 o'clock up here, it expired at 12, but we're still short. Going. Okay? And so you can do the same thing over here. You could add in another one if you thought it was going to keep going down. You also might think it's going to start going up. Or let's say you have, here's one thought a lot of people don't think about, but let's say you have this contract on, and let's say you're short right now, still, okay, on the S&P contract. So to show you an example, like this one right here, okay? And there we go, yeah, so we got that on top there. So you're short that contract, but maybe now you're getting a little nervous. You're seeing the thing go flat, we're at the lunch hour, we're getting in the later half of the day. You're thinking maybe the market will reverse. And so what you decide to do is maybe put on another spread to help protect some of your profit. Okay? So you could go on and say, you know what, just in case this thing does turn around, because it's sort of a seesawing quite a bit here since like 1 o'clock and for about the last 40 minutes, you could go on and you could say pick this spread to hedge you till 3 o'clock. And what that would do is, again, if you sold at 1715.25 right now, it would hedge you up to 1716.6 and up. So there's basically, 1.5 points, which is about $75 of your profit right now that you could lose, but you wouldn't lose more than that. So we're up $175 on the trade from shorting this morning. Well, you could give up a potential of $75. Doesn't mean it's going to cost you $75, but give a potential of $75, and that way you still can stay in the trade. If it drops down, you know what? No big deal. That's awesome, actually. If the market drops and you keep making money, but if it goes back up, you don't have to have a stop, like literally just a point above where the market is right now. Okay, and that allows you to get basically put your stop loss in without having to actually get stopped out of the trade. And so you have the potential to continue being profitable on the trade by tiering in and using spreads, which is a thought a lot of people don't think about. Not only can you use them to hedge your original position, but you can hedge them to trail your stops so you don't get stopped out of your trade on a trailing stop. And really give room to let your profits run. So it's a pretty cool way. Now, some people, maybe you're just a Nadex trader. And you're like, I like that, but I don't, that's not really my thing or whatever. And but you like the idea. You see the benefit. Well, what you could do is you could use the master spread if you wanted to, or you could use one of the big middle spreads that expire at 4:15, because they'll be right at break-even distance. I mean, you're talking 3 ticks, which sounds big. But remember, Nadex ticks in 0.1, so it's really 0.3. Okay, it's 0.3 is the distance to break even. So if that's the only distance to break even is 0.3, well, that's basically a tick, because a tick on ES is 0.25. So you could go in, you could take advantage of, and you could do a smaller position. Maybe you don't have as large of an account. Maybe you don't want to do an E-mini. Maybe you want to do half of an E-mini, type thing. Well, you can't do that on futures, but you can do that on spreads. And so you could go in here right now, and you could sell this contract for 1715.7. Okay, so that's 3 ticks away, basically, from where the market's at 1716. That's why that's the break-even distance. You go in there and sell that contract, and then you could buy this to hedge it off, so you weren't taking on $158 of risk. So it's just one of the many ways to trade it. Now, obviously, you could try to sell. You could see if you could find a sell contract. We'll look at that. And so over here, you go, well, is there one with the good ceiling? And you can check this out for 3 o'clock, okay? So you could go into this contract, but it's going to have to move down 26, so that's 2 points before you're break even on the trade. Okay, whereas this one you'd be break even within less than a point. By choosing to combine the two, you'd actually be able to make money sooner. And also, again, being in the 4:15 or in the future contract, you have till the end of the day. Whereas if you choose like just the 3 o'clock, you don't have as long. So you'd have to go down here to try to find a 4:15, and you'd have to increase the amount of money you got to put up substantially. So I just want to get you thinking about different ways to use spreads, whether you combine a master spread or a middle spread that expires at end of day with maybe a shorter term one to hedge it, or you could just use the spread if you wanted to. But also you could use the spreads to lock in your profits as a sort of a simulated trailing stop for yourself, so that way you don't just get stopped out by maybe a 3-point pullback and then all of a sudden the market drops 10 points. And this is a trade you can even do on big announcement days. Now, I'd probably pick a little wider one, depending upon the size of the announcement, but I'm in FOMC. You could go and you could have hedged with a 4:15 spread if you wanted to. And, taking advantage of a very large possible move. But if it goes against you, you know what? You're hedged. You're okay. So it's pretty cool. You just got to start figuring out what's going to be the best model for you. But this would be the risk-reward model. Over here, it actually charts it up here at the top. So you see your risk and reward. Now, this is based on just one contract on the US 500. And then you just multiply it times how many ever you want to do. But you can see right here, it hedges your risk. So the hedge is making money while the short spread that you're directionally short is losing money. Okay? And then, so basically it's making money while the other one's losing it. And then as the market moves on up over here, market moves down, then the spread that you went short can be profitable on that trade. So, anyways, check that out. Start playing with it. Get a free trial to the spread scanner. Check that out. See how it works. And, feel free to ask me any questions as well. And back in the members area there, I'll be glad to help you or call in or anything like that. Tiger's Den, etc. Be glad to help you learn how to apply this strategy to your current futures and forex trading. All right, now let's go ahead and let's check out the news. So we had a news event last night. We had the pound dollar. So let me pull that one up. And the stats on that trade, let me get those going for you as well. We'll look over at those and put all the pieces together. And just sort of review the stats. Because the more you can learn about these, the more you start exploring them. Again, one of my favorite ways to trade. And if there's a trade there, which often there is, every once in a while, like yesterday, we only had like 1 out of 6 as a possibility. But usually we have a pretty solid, good trade that's available. And this morning you had a great one that you could have taken advantage of on the pound dollar when the report came out. And let me pull that up again. But it was a pretty big difference from the expectation. And the pound itself, the retail sales were expected to come in at 0.4%. And I was like, hey, if this thing hits 1 or 0, we're going to get a big move. If it hits 1, the pound's going to fly up. It hits 0, we're going to big move down. The thing hits negative 0.9. Well, the cool thing is I don't have to know what's going to happen before it happens, okay? I just have to have an expectation on movement. And what were the expectations we had on this move? We had an expectation that 70% of the time, it hits at least 50 pips from high to low within 2 hours. And the average move from high to low is 70 pips. So, if we go in and look at this trade, let's look at the high. Now, from the right before the news to the low, we had 50 pips. But remember, the measurement is high to low. So we not only did hit that, but also the high to the low was 69. So remember, the average move is 70 pips. So, it was right on the money. When it made that average move, that's when you'd be tightening your stops, or you could get out at a 1-to-1, either way. But at the 70 pips, it's definitely, hey, it's time to get out of the trade. And you either would have made 1-to-1 or higher if you would have straddled that pound dollar trade this morning at 4:30. And then other trades, we had the butterflies before the news that you could take advantage of this morning. And so if I go over and look at, say, euro dollar, the average high to low an hour before the news was 30 pips. Well, we only had a move, I want to say it was like 17 pips on the euro dollar this morning between 9 and 10 when the new home sale or existing home sales report came out. So that right there actually allowed us to go in and take advantage of a flat market. And you could do the same thing on the Aussie dollar. It stayed like right within the 15 pip high to low expectation. So there was a lot of them right there that you could do. Let's see if I can pull up the euro one over here. There we go. And so you can see the euro right there, like high to low 16 pips. We had an expectation of 30. And the Aussie dollar, let's see here. I'll get the exact stats for you on it again. The Aussie dollar, the high to low expectation on it, it was like 15 pips, and we hit right in that range. It was perfect move. And so you can do these like 90 minutes before, 60 minutes before, 30 minutes before, all expiring right before the news comes out, like we're doing the FOMC, except for we didn't have all the weird implied volatility issues that we had. Because the nice thing in the morning is you have implied volatility built in automatically. It was 20 pips. So actually the high to low was 20 pips. And we had a high to low, the actual range was 19. So it was within one tick. So it was actually right on. Anyways, the beautiful thing is here, in the morning you have increased implied volatility because there's a lot of market movement in the morning. So simply because there is news, there's a lot of market movement. And not just news, but just the market opening. So with the market opening, that increases the implied volatility first thing in the morning. So you get more premium for your time there, and allows you to get a little wider on the binary butterflies. Okay, so that is the wrap for the news today. We had, like I said, the pound dollar. The report came in much worse than expected. All the U.S. stuff came in actually great. We had existing home sales coming at 5.48 million over 5.27 expected. Philly Fed came in at 22.3 versus 10.2. We had unemployment claims coming at 309,000 versus 331. So what's up with the down move? We had that massive up move yesterday. So the market ran up and basically just had to retrace. There was nobody left to buy. It's like, okay, that's great news. And you see this little pop in the market on the S&P. Well, that's awesome. But again, the market was exhausted. All the buyers that existed had bought and like crazy. And so remember, now it doesn't mean that more won't come in over time, but as far as like during that short span and time frame, they'd already bought into the market. And so, we saw the news come out right here at 10 o'clock, and we got a little bit of a pop, right there, boom. So, but then all of a sudden it sold on back off. And, when I was looking at this, I was like, what, I expect maybe a 10 to 15 minute up move off this news, and then I expect it to pull on back down. And that's exactly what happened. It pulled up for about 10 minutes, 15 minutes, and then it ran on back down because you get about a 15-minute shock and awe effect off of the news. And there's also a minor impact news event. It usually doesn't have a massive impact on the market itself. You'll get a pump and then it'll drop back to where it was going. And remember, market falls because there's no buyers above the market, not because there's so many sellers. All right, stay right there. We'll be right back after this break.
You've always taken the long view when it comes to investing, but what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while seeking to reduce your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
On Wednesday, August 14th and Thursday, August 15th, Tom O'Brien advised his Gold Report subscribers to close out 6 of their 9 open positions, all winning trades ranging from a 10.6% profit to an incredible 48% profit in just one equity. And all 6 of those winning trades had been initiated no earlier than just the previous month. With the 600th weekly Gold Report issue fast approaching, Tom O'Brien brings an incredible wealth of knowledge and experience to the gold market and the equities within the industry. That's almost 12 years since this powerful newsletter first began, and right now you can get a 30-day free trial to the Gold Report by visiting TFNN.com. Make sure you're a subscriber, as this volatile gold market provides trading opportunities after declining all the way from $1,900 to under $1,200 an ounce in only 2 years. Get your 30-day free trial to the Gold Report today by visiting TFNN.com.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, welcome on back here to the Diagnostic Trading Hour. And just looking at a few things right now, just trying to see what all we got that we can take advantage of maybe next week. What's going to be on the roster for the news. And so let's see what we got. Well, pulling it on up. By the way, nothing really big on the list for tomorrow. We got a quarter CPI on the USD CAD at 830. Be aware of that. That will expect 20 to 30 pip volatility on the CAD unless it's just drastically off. But usually not a major market mover. This weekend, we do have the German federal elections. So we'll be electing for the German federal parliament, and this is every 4 years. So this will be important, and they'll, of course, make the announcement that this could have an effect because, of course, Germany having a big impact on the EU and everything else. But it's a big decision time for the euro. It's going to impact possibly, Greece and everything else and all that other fun stuff. So just be aware. But there's, Merkel, and then what's the challenger? I'm trying to remember the name of the challenger for Tim Merkel. It's Pierre Steinbrück. I think that's how you say it. But Pierre Steinbrück, it's a Democratic rival. And anyway, so they're coming in, and so they'll be going back and forth. We'll see on all these elections that are coming out, these debates, these challengers on the federal elections. And then let's see, what do we got coming up? I'm trying to see if there's anything else Sunday. Japan's going to be closed for a bank holiday, so that'll affect FX if you're a FX trader, yen trader. And let's see, walking on into Monday, German flash manufacturing PMI at 330. The French flash doesn't really have any impact. German flash can have a decent impact, 20 to 30 pips. We'll have ECB, Draghi's going to be speaking Monday morning at 9 o'clock. Who knows what's going to come out of his mouth, especially after the FOMC report, so expect some volatility on the euro at 9 a.m. on Monday. Rolling on over to Tuesday, we'll have German IFO business climate, which will affect the euro at 4 o'clock. Again, 20 to 30 pip movement. We'll go into core retail sales on the CAD. That could have some movement. I'll go over the stats with you if there's anything there on Monday. And then we got consumer confidence here in the U.S. Again, not a big market mover in and of itself, but one to be aware of. It will cause an impact, sort of like this morning, for probably about 15 minutes. And then, let's see, nothing else that major to worry about there. And then if we can roll on into Wednesday, we're going to get a core durable good orders at 8:30. That will probably be tradable. Like I said, I'll get the stats for you on Tuesday on that one at 8:30 on Wednesday here in the U.S. And we'll have new home sales in the U.S. at 10 o'clock. Again, that'll be very similar to today. You'll have a bit of a pop for a few minutes and then over. Not really a tradable event, but more one to be aware of for your own trading. And just be aware of, this morning, I was like, hey, I expected to pull back. And so I stayed in the gap trade despite the news coming out. And then we got the pound there. We got a current account coming out. That'll affect it a little bit. It's final GDP. So we'll have some effect on the pound at 4:30 on Thursday. Unemployment claims on Thursday. And big home sales week. Got pending home sales on Thursday as well at 10 o'clock. And all those reports ought to be pretty much like what we had today on the home sales there. And then on Friday, ECB, Draghi speaking. We'll have Italian bond auctions. Those shouldn't have an impact unless it's just, the yields go way up or something drastic there. And a lot of FOMC members speaking on Friday. So you might want to be aware of that. Evans is going to be speaking here at 5:45 on next Friday. Again at 10:45, so busy guy. Rosengrun's going to be speaking at 8:30, and Dudley's going to be speaking at 2. So, no major news, but a lot of little news impacts that you'll just want to be aware of when they're coming out, so you can, take your risk and handle it accordingly. All right, everybody have a great day. Have a safe weekend. I'll see you Monday. Stay tuned for another great show coming up right after this.
Questions are the answer. You want a better life? Ask a better question. My driving force in life is, how can I become the intelligence behind financial freedom? It's why I take massive action. It's why I've invested over 10,000 hours and thousands of dollars to create the answer, the ultimate money machine. Hi, I'm Steve Rhodes, and on Friday, September 27th, I'll be hosting a one-day online master trader course, The Ultimate Money Machine, where I'll teach you the exact same trading strategies that I use every day when trading the markets and advising my newsletter subscribers. Learn how to precisely identify the market's next move, when to pull the trigger by letting the market commit to you before you commit to it, and how to manage your trade to maximize your results, just as we did in the month of August, when I advised my newsletter subscribers of 11 new trades, resulting in 1 loss and a combined profit of 129%. Our next move? It's days away. The cost of this course, $595, less than $2.50 per trading session over the next year. If you're looking for the answer, it's the Ultimate Money Machine. All the details on the front page of TFNN.com.